The gold price is still tradable, but the spreads are starting to confess what the headline won't. And that confession is exactly how the paper gold game breaks. Right now, the chart looks like a simple story. Gold tagged a fresh all-time high near 4,250 late last week, and then slipped back toward the 4,470 area today on year-end profit-taking. Clean, understandable, tradable, but that's the decoy. Because the break doesn't start with a dramatic candle, it starts when the market's plumbing stops offering cheap time. And once time stops being cheap, paper stops feeling like gold. And that's where the real pressure starts. Here is the conflict you're watching in real time. A market built to move claims on gold at lightning speed, running into a world where actual metal moves like molasses. Futures can be sold in a blink, options can be stacked in seconds, leverage can multiply exposure without anyone touching a bar. That's the paper game, and it's not automatically evil, it's just a structure. But every structure has a limit, and gold's limit is always the same. It's not a tweet, it's not a politician, it's not even inflation prints. It S when immediate metal becomes more valuable than future metal, when the market starts paying you to give up time instead of charging you for it. Because in a normal world, gold costs money to carry. You pay financing, you pay storage, you pay insurance, you pay for the privilege of waiting. That's why the forward curve usually slopes upward. That's why contango is the default. And when that curve compresses, flattens, or tries to invert in a metal like gold, the story shifts from macro narrative to funding stress. And that's not the part most people are watching. Most people are watching the headline price. They're watching whether 4,500 holds. They're watching whether the pullback means it's over. And that's exactly how they get played. Because price is the last place the stress has to show up. Before price breaks, spreads break. Before spreads break, financing tightens. Before financing tightens, the willingness to lend metal quietly disappears. And if you're not looking there, you're watching shadows. Because if this one mechanism flips, the math changes. Let's strip the paper gold game down to one clean idea. The global gold market isn't one market. It's two markets stitched together by trust and arbitrage. On one side, you have the paper layer. Futures, options, swaps, unallocated claims, structures designed for liquidity, hedging, and leverage. On the other side, you have the physical layer, bars that must be refined to spec, vaulted, insured, moved, and delivered under rules that don't care about your chart. The stitch between them is the carry trade and the basis, the ability to buy here, sell there, borrow metal, lend cash, roll positions forward, and keep everything in line because time has a cost, and that cost is stable. When that stitch loosens, the whole suit starts tearing at the seams. Here's what break really means in finance language without the drama. It means the cost of maintaining paper exposure starts rising faster than the ability of participants to roll it. It means spreads start pricing stress. It means the nearby contract starts demanding a premium relative to the deferred contract. It means the market is telling you, I don't want your promise for later, I want settlement sooner. And when that preference spreads, the game changes from who has the best macro take to who can source liquidity and metal without getting squeezed. That's when forced buying shows up, not because someone got bullish, because someone ran out of runway, but that's not the part that matters. The part that matters is why this is happening now, specifically now, not in some vague future where every gold bull is always early. This is year-end. That's not a poetic detail, it's a mechanical one. Year-end is when liquidity thins and risk managers tighten screws. It's when books get squared. It's when dealers think about balance sheet usage. It's when funds lock in performance. It's when margin thresholds and internal limits get enforced with less patience. Even in calm markets, year-end creates air pockets. In volatile markets, it creates traps. And when you combine that with a metal that just ran to record highs, you get a perfect recipe for violent whipsaws that shake out weak hands while the underlying mechanism keeps building. Because price can whip around violently even if the thesis is correct. That's the credibility line. And if you don't internalize it, you'll misread the tape at exactly the wrong time. So let's talk about the hidden detail that reframes everything. It's not a rumor. It's not a screenshot. It's not a secret meeting. It's the quiet, underappreciated signal that shows up in the cost to borrow and source gold. Financing tension that leaks into forward points, into lease dynamics, into the way the curve behaves when real supply is not eager to be lent. You don't need a perfect data set to understand the direction. You just need to understand the incentive. When carrying gold becomes less attractive for lenders and more urgent for borrowers, the paper layer starts paying up to secure access to metal. That shows up first as curve compression, then as spread weirdness, then as position management stress, then, finally, as headline price doing something sudden. And the next detail is what flips the whole setup. Because gold is not supposed to invert like an industrial commodity. Oil can go backwardated. when inventories are low and demand is immediate. Copper can invert when warehouses drain. Those are consumption-driven markets. Gold is different. Gold is monetary and stock-to-flow heavy. There's always a lot of gold in the world. That's why people get complacent. But markets don't price a lot. Markets price available to deliver at the margin under the rules on the timeline. That's a completely different thing. You can have plenty of gold in existence and still have tightness in deliverable supply where it matters. And if you've ever watched a market seize up, you know it's never about total supply. It's about usable supply at the wrong moment. That's where the real pressure starts. Now layer in market structure. If you're short paper gold, maybe as a hedge, maybe as a spread, maybe as a tactical bet, you can survive being wrong on direction for a while if rolling is cheap. You just push the problem forward. You sell the next month, you buy back the front, you keep the exposure, you bleed a little, that's the game. But when the curve compresses and rolling becomes expensive, your position stops being a directional bet and becomes a funding problem. The monthly roll becomes a tax, the spread becomes a stress test. And stress tests have a way of turning rational positioning into forced action. But that's not the part that matters. The part that matters is the sequence. Spreads move first, then positioning cracks, then price gaps. This is why the headline price can lie. Not because it's fake, because it's incomplete. You can push the last traded price around with liquidity and leverage, especially during thin conditions. You can trigger stops. You can cause temporary cascades. But if the underlying system is becoming less willing to provide cheap carry, if lenders of metal pull back, if the cost of time rises, if immediate availability gets prized, the pressure doesn't go away. It just relocates. It waits. It builds. And then it pops when the wrong side can't roll. The calendar is the catalyst, and that's not a slogan. It's a schedule. Now, let's talk about the part everyone repeats, but almost nobody explains cleanly: inventory. You'll hear people say, look, warehouses have plenty of metal. Or the opposite. Warehouses are draining. It's over. Both takes are usually lazy because inventory categories matter more than the headline total. In futures world, there is a huge difference between metal that is eligible to be delivered and metal that is registered, committed, or otherwise positioned to settle a contract. Eligible is basically, it exists in approved form, in an approved place. Registered is closer to, it's earmarked and available under the system's rules. That gap is where stress hides. Because if most of the metal is technically eligible but not actually committed, the system can look flush while being functionally tight at the margin. And in a stress moment, margins are everything. So what does a tight margin look like in behavior terms? It looks like higher urgency to secure a nearby settlement. It looks like greater sensitivity to delivery windows. It looks like an unwillingness to lend metal into the market because the lender senses a better use for it. Maybe hoarding, maybe reserve management, maybe simple caution. It looks like the paper market having to offer better terms to coax metal out. And that's where the real pressure starts. Now add another layer: physical versus paper pricing signals. You don't always see physical tightness directly in spot, because spot is often a reference price born from the paper layer. Physical tightness often shows up in the shadow prices: premiums, availability, delivery times, local market spreads, and the behavior of arbitrage. If a region is willing to pay more for real bars, that premium becomes a magnet. Arbitrage tries to close it. Arbitrage pulls metal. Pulling metal stresses logistics. Stressing logistics raises the value of immediate deliverable supply. Raising the value of immediate supply compresses the curve. Compressing the curve stresses the roll. Stressing the roll forces buying. And forced buying is the part that makes people call it a sudden breakout. But the breakout is the last domino, not the first. Because if this one level breaks, the math changes. Let's be brutally practical about what you should be watching in the next week or two, because otherwise this turns into a story with no payoff. The tells aren't headlines. The tells are whether dips get bought without spreads relaxing. The tells are whether the market can pull back while financing pressure stays elevated. The tells are whether nearby contracts remain sticky relative to deferred ones. The tells are whether rollover becomes more expensive right when risk managers want positions smaller. That combination is gasoline. And there's just another subtle layer that makes this specific moment extra dangerous for anyone leaning the wrong way. Options reflexivity. You don't need a cartoon gamma squeeze narrative to respect the impact. When price moves quickly through big strikes, dealers who are short options can be forced to hedge dynamically. If calls are being chased, hedging can mean buying futures as price rises, which adds fuel. If puts are heavy and price drops into them, hedging can mean selling, which adds acceleration. In thin liquidity, these hedging flows matter more. They don't need to be the whole story. They just need to amplify the story at the worst possible time. And year-end is exactly when amplification is most likely. But that's not the part that matters. The part that matters is how this interacts with the physical layer. Because the paper gold game only stays stable when participants believe They can always exchange paper for paper, roll for roll, and never get forced into the physical layer at an inconvenient moment. The moment that belief weakens, even slightly, behavior changes. Some participants start preferring allocated over unallocated. Some prefer nearby settlement over forward promises. Some stop lending. Some increase haircuts. Some reduce balance sheet. None of that requires a grand narrative. It's the normal response of institutions managing risk. And risk management is the silent engine behind most mysterious market moves. Now, let's stack proof points without pretending we have perfect real-time visibility into every vault. Proof point 1 is the price behavior itself. A record high near 4,550, followed by a sharp pullback toward 4,170s on year-end profit-taking is not bearish by itself. It's what you expect when a market is crowded, up huge on the year, and liquidity is thin. Violent mean reversion is normal. The question is not, did it pull back? The question is, did it pull back in a way that relieves stress? Because a healthy reset looks like price cooling while the underlying structure normalizes. A stressed market looks like price cooling while the underlying structure stays tight. And that's where the real pressure starts. Proof point 2 is the macro backdrop that keeps gold bid structurally even when it whipsaws tactically. When markets expect easier policy, when the dollar softens, when geopolitical risk rises, when public debt anxiety creeps in, gold benefits. But even more importantly, these conditions increase the willingness of institutions to hold gold as a reserve asset rather than as a trading chip. And when gold is held, not lent, the paper layer loses cheap supply. That's the hidden link between macro regime and market plumbing. Proof point 3 is institutional flow behavior, especially in vehicles that turn many small decisions into one big mechanical demand. Gold-backed ETFs and similar products matter because in periods of net creation, they can require real metal sourcing and custody changes. They don't have to be the dominant force every day. They just need to be persistent enough to tighten the marginal availability of lendable gold. When you combine that with year-end balance sheet caution, the same flow can have a bigger impact than it would in a normal month. But that's not the part that matters. The part that matters is that these flows don't care about your intraday chart. They create structural pull. Proof point 4 is official sector behavior. Central banks have been vocal in surveys about the ongoing importance of gold in reserves, and reported buying has been a recurring tailwind in recent years. Central banks don't chase momentum the way a day trader does, but they do something arguably more powerful. They provide a floor of steady preference for gold as a strategic asset. That changes the market's reflex. It teaches participants that dips can be absorbed. And when dips are absorbed, shorts don't get the easy unwind they're hoping for. The result is not immediate fireworks. It's gradual tightening of the exit doors. And that's where the real pressure starts. Proof point 5 is the global arbitrage reality. The most important price is often the marginal price, the place where demand is least price sensitive because the buyer is solving a real problem, not expressing a hot take. When regional premiums rise, when local demand pulls harder, arbitrage tries to close the gap by moving supply. But supply has lead times, refining has constraints, logistics have friction. Those frictions can't be papered over instantly. And in that window, the value of immediate deliverable gold rises. That's the mechanism that makes a monetary metal behave, temporarily like a tight industrial commodity. And if that happens while paper positioning is heavy, the squeeze potential grows. Proof point 6, and this is the one everyone underestimates, is behavioral. Markets use volatility as a weapon. They don't need a mastermind. The structure does it automatically. When price spikes, it triggers fear of missing out. When price dumps, it triggers panic and I knew it narratives. Both emotions push retail into bad timing, chasing highs and selling lows. Meanwhile, professionals think in timelines and mechanics. They think, what forces who to do what, by when, under what constraints. If you internalize that difference, you stop reacting to candles and start tracking pressure. And the next detail is what flips the whole setup. Pressure can build even while price chops. So let's talk about the levels, but without fake precision. If that shelf breaks cleanly and liquidity accelerates the move, you can see a deeper flush, not because the thesis dies, but because thin conditions punish everyone at once. And that distinction matters, because trend signal and noise are not the same thing. Here's the two scenario lens that keeps you sane and keeps this finance credible. Scenario 1 is the controlled pullback and retest. In this scenario, gold bleeds lower or chops sideways, shakes out late longs, lets momentum cool, maybe drifts toward a deeper support zone, and then reclaims the shelf with real buying. The confirmation isn't a green candle. The confirmation is that the pullback doesn't normalize the plumbing. You watch whether nearby tightness persists, whether roll costs remain elevated, whether dips attract steady demand rather than a vacuum. If that happens, the market is basically telling you it's reloading, not reversing. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the market doesn't give you a polite retest. It holds the shelf, snaps back quickly, takes out the recent highs, and liquidity thins right when hedging demand increases. That's when gaps happen. That's when price discovery gets jumpy. That's when the chart starts moving faster than your emotions can process. And that's exactly when retail gets emotionally manipulated, either into chasing because it is obvious or into freezing because it's too late. But that's not the part that matters. The part that matters is that in a squeeze, the move is driven by forced behavior, not comfort. And forced behavior doesn't negotiate with your timing. Now, let's be clear about invalidation, because trust is built on what would make you wrong. If the market's plumbing genuinely relaxes, if carry becomes cheap again, if the curve steepens normally, if liquidity returns, if physical signals cool, if the market can trade lower without the sense of urgency and nearby settlement, then the paper breaks narrative weakens. Not because gold can't be bullish long-term, but because the specific stress mechanism would be easing. Similarly, if macro conditions shift hard the other way, unexpected tightening, a sudden surge in real yields, a sharp dollar rally, a broad liquidation event, gold can get hit even if the structural story remains. That's not a contradiction, that's markets. Price can whip around violently even if the thesis is correct, and it can also move against you when you're conceptually right. That's why risk framing matters more than conviction. So what comes next, in practical terms? Right into next week. You watch the calendar, you watch whether year-end flows reverse into early January re-risking, or whether the caution persists. You watch whether the market treats dips as inventory to be accumulated or as relief to exit. You watch whether the next push-up happens on thick liquidity or on thin air, because thin air rallies are the ones that gap and trap. You watch whether the market respects the post-peak shelf around the mid-4,400s. And you watch the one metric most people ignore, the price of time in gold. Because when the market starts paying a premium for now over later, the paper game stops being a smooth machine and starts becoming a contest for settlement. And if you're wondering why this matters to you as a retail investor, someone who is in T rolling futures and negotiating financing, the answer is simple. The paper gold game determines how violently the headline price can move and how many fake signals you'll be fed in the process. When the plumbing is stressed, price becomes a weapon. You'll get whipsaws designed by structure, not malice. Stop runs, fast dumps, fast recoveries, everything that makes you doubt your own plan. The psychology shield is recognizing that volatility is not a verdict. It's a tool. It's used to transfer positions from impatient hands to patient hands. Your job is not to predict every tick. Your job is to know what would confirm the mechanism and what would break it. Here's a simple way to think about it without turning this into a trading sermon. Separate the signal from the noise. Signal is structural, persistent demand that shows up on dips, curve behavior that suggests urgency for nearby settlement, institutional flows that keep leaning in, and a market that can't stay down even when it should. Noise is the emotional theater. The day-to-day headlines, the temporary peace rumor, the one-day dollar pop, the profit-taking flush and thin liquidity. Noise can move price. Signal can move regimes. And the next detail is what flips the whole setup. Regimes change quietly, then suddenly. So when I say the paper gold game breaks when this happens, I'm not saying gold becomes untradeable overnight, or that the system collapses in a movie scene. I'm saying the incentives shift. I'm saying the cost of maintaining paper exposure rises. The willingness to lend metal declines. And the spread structure starts telling the truth before the headline price does. When that happens, the market stops behaving like a smooth auction and starts behaving like a liquidity puzzle. And liquidity puzzles end the same way. Someone pays up because they have to, not because they want to. If you want one final checklist you can run in your head without drowning in data, it's this. First, where's price relative to the recent high near 4,550 and the current shelf around the mid-4,400s? Second, what does the market do on dips? Does it bounce quickly or does it vacuum lower? Third, do the hidden mode signals calm down or stay tight? Does the value of immediate settlement stay elevated relative to later settlement? Fourth, do institutional behaviors remain supportive? Steady allocation, steady flow, steady official sector preference? Fifth, does volatility increase right as the market approaches key levels, suggesting hedging and forced behavior? Or does it fade, suggesting exhaustion? That's a real roadmap, and it works whether you're bullish, bearish, or just trying not to get emotionally wrecked by the chop. And here is the quiet warning most people need to hear at the top of a gold mania. The market will try to use volatility against you. It will make you feel late when you should be patient. It will make you feel foolish when you should be disciplined. It will tempt you into oversizing when the correct move is usually to respect uncertainty and time horizon. Gold can be the cleanest macro signal in the world and still shake you out twice before it moves. That's not a flaw. That's the mechanism doing its job. So if you're here for mechanisms over mania, keep your eyes on the plumbing with the rest of us. Watch the price, yes, but trust the spread when it starts screaming. Watch the calendar, because year end and early January are not neutral. Watch the behavior on dips, because that's where real demand reveals itself. And above all, watch the value of now versus later, because when the market stops offering cheap time, the paper gold game stops feeling like a game, and that's when the next leg becomes possible, not because of a narrative, but because of math.